Now, previously, I've said that I don't expect the US economy to go into recession because consumer spending is strong and fundamentals are strong. But after looking at all my research data, I have to admit something that I was dead wrong. Because the US economy is already in a recession. That's right. So some of you actually commented that we are in a recession, and now I admit that you guys were right, I was wrong. The US economy has been in a recession now for already 12 months, for the last 4 quarters. Now, bear in mind that when I use the word recession, it's not official recession. So officially, we are not in a recession. But what I mean by recession is that the US economy has been in a rolling recession. What's a rolling recession? It is one where different parts of the economy go into recession at different stages. So for example, you've got the financial sector going into a recession, and then the technology sector going into a recession, and then the healthcare going into recession. So they take turns going into a recession, but they don't all go into a recession at the same time. So you don't have an economy-wide recession, but you have got what we call a rolling recession that hits different parts of the economy at different times. So why do I say that the economy has been in a recession, a rolling recession for the last 12 months? Because corporate earnings, excluding energy, has actually started declining in Q2 of last year. There, you can see decline in Q2 last year, Q3, Q4, and right now we're in Q1 2023, and it has declined as well. So it's been declining for the last 4 quarters or the last 12 months. Remember something, that the stock market is a leading indicator of the economy. So the stock market doesn't care what's happening now. The stock market prices in what it thinks will happen in 6 to 9 months ahead, which is 2 quarters to 3 quarters ahead. Now, here is where it gets interesting. Now, if you look at the S&P 500, remember the market bottomed last year in October, right there. That was the end of the bear market, right? So why did it bottom in October last year? Because remember that the market looks 2 to 3 quarters ahead. And the market could see that corporate earnings or the economy would bottom in Q1 this year. And if you look 1 quarter or 2 quarters before that, that's where the market bottomed. So the market bottomed here because it priced in the bottom 2 quarters ahead. That's why the market bottomed last year. Does this make sense? Now, right now we are right here. We're in Q1, right? So why is the market keep going up? Because the market is looking 2 to 3 quarters ahead, which means the market is now pricing in Q3 this year and Q1 next year. This is what the market is looking at. This and this. The market is seeing that corporate earnings are growing, and that's why the stock market is going up. Now, although corporate earnings as a whole has been contracting in this first quarter of the year, it has been contracting less than feared. Earnings have come in better than expected. So far, we've got 53% of the S&P 500 companies reporting earnings, and 79% have beaten expectations. So on the whole, analysts expected that corporate earnings would decline 6.7% this quarter, but it has only declined 3.7%, a lot better than expected. And that's why, again, the market is rallying very, very strongly. So when people wonder, hey, how can the market go up? When, in the past, they thought that the market went up because of quantitative easing, because of increasing money supply. But now money supply is going down. And people are wondering, why is the market going up? Is the market rigged? No, the market's going up because corporate earnings, the contraction has already bottomed. It's through this quarter, and the market is looking ahead for earnings growth in the next 2 to 4 quarters. And that's what's driving the market higher. So if you take a look at the chart of the S&P 500, we can take a look at the price action. And you can see we are clearly still on that uptrend. We are clearly still on this bull market unofficially, which I've called it, right? We can see the 20 EMA, this red line above the 40 EMA. That is a sign of a short-term uptrend. In fact, I tend to trade stocks long when the 20 is above the 40 EMA. At the same time, the 50 moving average, the blue line, the thick blue line, is above the 150 moving average, which signals a medium-term uptrend. The market's above the 200-day moving average in red, the 200 sloping up, which signals the longer-term uptrend. So we've got the short-term trend up, medium-term trend up, long-term trend up. The market's on a very, very strong uptrend. Now, of course, this doesn't predict how long the trend will last, but as long as it's on an uptrend, the trend is your friend. The path of least resistance is we are going higher. Now, like I said many times, we are officially not in a bull market yet, because to be in a bull market, the S&P has to close 20% above the bear market low, which is about 4,200 points, which is just within striking distance. So it's going to be interesting to see that within this week, if we can close above this level, that will be officially a bull market. But I've said, personally, I think that we have already been in a bull market ever since October last year. We've been in a bull market now for, 1, 2, 3, 4, 5. We've been in a bull market now for 6 months. And the reason I say that is because, again, historically, when the 50 moving average crosses above the 150 moving average and is sloped up, that has been a very strong predictor of bull markets with a 90% accuracy. Now, of course, the majority of institutional investors and financial gurus still don't believe it's a bull market. They say, no, this is not a bull market, it's still a bear market rally. It will eventually crash and make a new low lower than the October low. Now, of course, everything is possible, but if you ask me, I think that it's increasingly unlikely that this is a bear market rally for a few reasons. Number one reason is we are currently in 135 days into this so-called rally, right, which is about 4.5 months. Now, never in history has a bear market rally been 4.5 months. If you look at the dot-com crash in 2000, 2001, there were several bear market rallies, and the longest was 121 days, all right? If you look at the financial crisis, there were a few bear market rallies as well. No bear market rally lasted for more than 44 days. So given the fact that this is already 135 days, it's very unlikely it's going to be a bear market rally. Now, of course, everything is possible. It could happen. And if we make a new low because of something that happens in the external world, then it's going to be the longest bear market rally in history. Okay. So my personal opinion is that we are still in the bull market and we may have a chance of closing above 4,002 and get into an official bull market really, really soon. So with all this happening, all this, bullish price action in the markets, what could go wrong? Okay, plenty could go wrong. Now I'm thinking in my mind that there are two things that could go wrong. Number one is that the Fed does something crazy. Number two, if the Democrats and Republicans can't agree to raise the debt ceiling in June, for example, and the US debt gets downgraded again, we could have a lot of volatility in the markets. We could see a big sell-off. All right, so the first event that could screw up this bull rally could be the next Fed meeting or the next two Fed meetings. So let's take a look at what's happening there. So the next meeting will be on the 3rd of May in 2 days, right? So on the 3rd of May, the Fed is meeting for the FOMC meeting. And right now, the Fed funds rate is currently at 4.755% range. That's the current rate right now. So you can see the market is pricing in an 89% probability that the Fed will raise interest rates by another 25 basis points or another 0.25%, 89% chance. And there's a 10% chance that they are not going to raise interest rates. So again, if this happens as anticipated, then the market should continue to rally. But if the Fed, raises by 50 basis points or 75 basis points, then sure, the market could sell off. Okay, and they could do that if they think that inflation is still a problem, which I don't think it is. And let's look at some charts in a while. Now, so this is the next meeting. Now, the meeting after next would be the 14th of June. And the market is pricing in the fact that once they raise rates the last time, 25 basis points, that's it. The Fed has ended their rate hike cycle. You can see there's a 63% chance they're going to pause on the 14th of June, a 7% chance they may even cut rates. And there is a 29% chance they may raise one more time. So again, as long as the Fed sticks to these parameters, the market should still rally up. Again, but if they think that inflation is still a problem, they raise more than expected, of course, we could get a sell-off. No one can predict that. But I don't think that may happen because everywhere I can see disinflation happening, okay? What are the catalysts of inflation? Number one, oil prices. Now, oil prices have been going down. Even when those bastards at OPEC, they cut their supply last month, that caused oil prices to jump up. It was not sustainable. Oil is coming back down again, okay? How about agriculture? You look at wheat. Wheat has been on a downtrend, going down. Corn has been going down. Lumber has been going down. Look at PPI, which is the producer price index. You can see that it has all been trending down, and in fact, it turned negative into deflation. In fact, deflation in the month of March of this year. So unless this reaccelerates, we should be pretty much in the home stretch of the Fed pausing their rate hikes. This is the 5-year break-even inflation rate, which is a leading indicator of inflation. You can see that it has also been on a very, very steady downtrend. All right, so that's the first thing that could go wrong, which I don't think is going to go wrong. Now, the second thing that could go wrong is the debt ceiling debacle. Now, as you guys know, what happens is that the US government, once in a while, they have to raise their debt ceiling in order to pay their bills. To raise the debt ceiling, the Republicans and Democrats have to agree, right? In the House, the Senate, the White House, they have to agree to raise the debt ceiling. But there's always a gridlock between the Democrats and the Republicans. And of course, the Republicans, given that the White House is being held by the Democrats, the Republicans are using this as a way to kind of like blackmail them. That if you don't cut federal spending, we're not going to agree to raising the debt ceiling. Now, usually at the last moment, they always agree. Okay, but sometimes the government shuts down for a few days before they get their act together. But in the worst case scenario, if they don't agree and the US defaults on its debt, that's Armageddon. That's freaking Armageddon. Now, I don't think it's going to happen, but you never know, right? You never know. So a lot of people have been asking about that, and let me just talk a bit about that. So basically, no one is clear when the US government is going to run out of money, right? It could be as early as the 5th of June to July, September, but let's take it as early June. So again, what happened recently is that the House, which is right now is led by the GOP, they have actually sent in a legislation to raise the debt ceiling on condition that the government freezes spending at last year's levels for a decade. And they want to roll back a lot of Biden's landmark health, climate, and tax laws. So Biden is expected to veto this, and the Senate is not expected to pass this bill. So that's gonna create a showdown in Washington, right? So as we move towards that deadline, the 5th of June, we may see some volatility in the markets, all right? Now, so what's the worst that could happen, okay? So let's take a look. Now, one of the worst market sell-offs that was a result of this was back in 2011. So in 2011, this was when Obama, was it Obama's time? Yeah, I think it was Obama, right? If I'm not wrong, it was Obama, all right? So during this time, what happened was August 2011, S&P downgraded the US sovereign debt from AAA rating to AA rating, and the markets freaked out. So the S&P 500 fell 20% during that 2 months. Now, that did not create a bear market because it did not close 20% below the high. It kind of like touched 20% and then flew back up. Okay, so in the end, it was a great opportunity to buy stocks. So if you believe that at the end of the day, things will be resolved, which I think they will be, any kind of volatility, any kind of sell-off, any kind of crash is a great opportunity to buy. Well, at least based on history, right? Now, it may surprise you to know that the US government being shut down because of this is not uncommon. It's pretty common. It has actually happened many, many times. This is a history of all the US government shutdowns because they couldn't pay their bills, right? 1981, 82, 83, 84, 86, 87, 1990, 95, 2013, and 2018. It's a very common affair, okay? So what happened during all those times when the US government shut down? Well, again, it ranged from 2 days to 21 days shut down to 34 days shut down in 2018. And 2018 was under Obama, right? That I'm really sure of. But what happened to the S&P 500? The S&P 500, you can see, was not always negative during the shutdown. In fact, there were a couple of positives, a couple of negatives, so it's kind of like a 50-50 thing, right? And it's not the end of the market. Even when it dropped like 1.5%, 2.5%, 0.9%, and bounced back really strongly in the next couple of weeks anyway. So remember that no matter what happens to the market, always take opportunity of short-term volatility. So far this year, my account or my portfolio, I've got several, as you know, this is just one of them, it's up about, let's see. Okay, there we are. So right now, my portfolio is up about 19.41% year to date, but it's still early in the year, so anything could happen. But I believe that by the end of the year, we should have a bullish year. We should have a nice gain in our investment portfolios. As long as we hold fundamentally great companies, hold the top 1% of companies in the world, and take advantage of short-term dips to accumulate bigger stakes in great companies. I'll see you guys in the next video. May the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.